Harvey. I'm one of the directors of Stanford Brown, one of the investment advisors and your MC for today. One would have thought you'd have to be living on a sunny island with no Wi-Fi reception or mobile reception to miss the daily news articles of higher inflation, higher interest rates, supply shocks and conflict all around the world. All of these topics are relevant for today, and we aim to provide some measure of perspective and then guidance on the directions that we think is wise with respects to investments and how we look after your capital. Now, amongst you are clients of many years, professionals that we've worked with for many years as well, and there are long-standing and strong relationships with lots of accountants and lawyers in the room. And there are also some of you here that are trying us on for the first time, so we welcome you all. Thank you very much for coming. In terms of today, so we plan to deliver information to you in the following format. Our first speaker will be Vincent O'Neill, who'll provide a brief update on Stanford Brown and the energy that we put into the business that we have built to serve you. We'll then have the privilege of hearing from one of our investment committee members, Ian McFarlane. Ian actually provided some insights to us last year, but I would have thought it would be a big miss to not ask Ian to join us again and talk about interest rates and central banks, which is such a topic du jour at the moment. We'll then be joined by Nick Ryder, our Chief Investment Officer, and finally, I'll then introduce you to one of the newest members of Stanford Brown, Joy Maracadé, who's our Senior Investment Director. We'll finish today at 2 p.m. sharp, but I do welcome you to stay, so people who have to go back to work can return to work, but I do encourage you to stay afterwards. We can have a glass of wine. We need to clear the room by 2:30 p.m. In terms of questions, when Ian and Nick conclude their initial presentations or discussions with Vincent, we will have 5 minutes or so for questions for each of them, and the best couple of questions get a book that Ian McFarlane wrote himself. So we'll come to that shortly, and there's a few other things that we'll mix the day up with. So I'll hand over to Vincent now and just get him up to the stage. Vincent O'Neill is our CEO. Vincent, I'll give you a quick bio. Vincent grew up in Northern Ireland and completed his undergraduate studies in commerce and law at the University College Dublin. After moving to Australia, he joined Stanford Brown in 2007, just after myself. He became an advisor and for the last 10 years has been the head of the private wealth division at Stanford Brown. And for the last 3 years, he's been the CEO. Vincent is a fabulous, hard-working individual, father of three, a truly well-rounded CEO. I welcome Vincent up to the stage. Come on up.
Thank you, Hamish. Thank you, Hamish. So good of you to get that feedback from my wife to share with the room. Thank you. I am here to share an update on behalf of Stanford Brown today, but I'm not the main event, so I'll keep it brief. As Hamish alluded to, I have been with Stanford Brown for many years. I joined Stanford Brown in 2007, and that was for those of you that can remember back, that was a very interesting time in the world of superannuation investments and finance. 2007 was the year that you had the last window to put $1 million into superannuation before the rules changed, and that was my first job as a client services. I actually was supporting Hamish, working for Hamish once I'd got his blessing to be fit to work with Hamish. And I got to deliver the $1 million checks on behalf of Hamish's clients to the different institutions as we were doing those deposits. The immediate years that followed, you don't need me to tell you what happened, and quickly we moved through the GFC and all the challenges that unfurled. And in that period, I was lucky enough, obviously Stanford Brown has changed a lot over that time, and when I joined the firm, it was a lot smaller than it is today, but what I can say is our core values very much remain the same, and I want to talk about 3 ways we bring those values to life in Stanford Brown and how we continue to keep that core ethos in what we do. I'd like to start, there's Hamish. It's probably best we quickly skip through those pictures anyway. I'd like to start by sharing with you our vision, and this is a vision that I share with our staff repeatedly, and it's very much about who we are and what we do. At Stanford Brown, we are in the peace of mind business. We worry about it all, much more than just the numbers, so clients don't have to. For over 30 years, we've empowered Australian families with the future that they want. Our aspiration is to be best known for our professional approach that sets us apart from our peers. Market-leading technical expertise across investments, insurance, strategic advice, and taxation. Exceptional service standards delivering peace of mind to our clients. And our heart, we advise to our clients with courage, but also with empathy. And our culture, we provide to our staff and to our clients leadership which is ambitious but yet humble, challenging but consistent. And I share that, I guess, to just for those of you that are new to Stanford Brown, because these are the things that we talk about every day in terms of who we are and how we make decisions around the future of our business. So now to move on and share with you 3 of those core values that drive everything we do as a business. 1, we build for the future at all levels. That starts with our board, my bosses, essentially. We have 3 internal board directors, Hamish, our founder, David Brown, and myself. And we are lucky enough to have 2 excellent non-executive directors. Anna Karabs, who will be known to many of you, led the King Living Group from 2015 to 2022. And prior to that, had a distinguished 20-year-plus career across Pricewaterhouse, William Buck, amongst other firms. And she is in the room today, actively critiquing, ready for the next board meeting. Welcome, Anna. We also expanded the expertise on our board earlier this year when we brought on board Murray Coble. Murray has over 30 years' experience in the financial services industry. Over 26 of those with Schroders, working out of Asia. And in particular, he was their chief operating officer for an extended period through there. So Murray also brings different perspectives, but very valuable perspectives to our board. And for us, the role of a board is very important because we see, I guess, a very sensitive and trustworthy position in terms of being custodians of your family wealth. And a board plays a very important role in making sure that we are not just short-term, but long-term in our decision-making to make sure that we are ultimately working towards that goal. We have also continued to invest for the future and broaden and deepen our internal investment expertise, bringing the likes of Nick Ryder on board. Nick with over 30 years experience at firms such as JB Ware, NAB, and more recently CBA Private. Joey Murakade, who you will hear from shortly, also got over 17 years experience across the UK, Singapore, and Australia. Hamish, you will know, myself, you will know, and Joseph, also our internal research analyst that supports Nick. Joseph is in the room. He's wearing the exact same outfit as that picture. I know that because that picture was only taken about 45 minutes ago. Last-minute scramble. No needed for last-minute pictures for external investment committee members. Again, Ian McFarlane needs no introduction. Led the RBA from 1996 to 2006 through the Asian financial crisis. Giselle Roux, former Chief Investment Officer of JB Ware and Escala. Nigel Douglas, who is Head of Research at Van Eyck and also Perpetual Private. The famous enigma, Ashley Owen, the wonderful entertainer that he is, remains on our investment committee. And Jana, a name possibly not as well known to everyone in the room. Jana, our institutional research partner. It's important for a firm, even of our scale, to be able to leverage off an institutional partner there that can bring their expertise over 33 years working with over 80 firms, particularly in the industry supersphere, large endowments, and government. So I guess that's a lot of pretty faces on a couple of slides there. But essentially, the whole purpose of what we aim to create here is create real rigor and create real depth in what we're doing for you. And in particular, what we are noticing is there's been a significant democratization of things like private assets, private equity, private credit, other types of investments that were previously only available or able to be accessed through the large institutions, and they're now available to our world. And we want to make sure we put together the right team with expertise across a series of backgrounds to help deliver the right solutions to you so that we can recommend them with confidence and strength. We also continue to invest in our people internally. I want to talk on 3 key initiatives that we consider important to building for the future, and that is the long-term future. Our Career Mastery Program, that is where we support our staff in completing their postgraduate studies to get a master's in financial planning. It's not long ago that there was a common joke that you could become a financial advisor after doing a weekend course or doing a quick 30-minute online course to become a financial advisor. Now, we've been through what we know we've been through in terms of the Royal Commission, and changes were needed, but they have been made. And now, to actually become a financial advisor, you not only need to basically have completed a dedicated degree or postgraduate master's in financial planning, you also need to complete a professional year. So we're big positive believers in the value of that, and we are big investors in our Career Mastery Program. We have a profit incentive plan that ensures that those long-term staff members of Stanford Brown that have served with us for over a couple of years, outside of those usually glamorous roles of management or advice, are also getting a slice of the profits to which they help create. And our long-term employee equity plan that we're rolling out this year to long-term staff members outside of the management or advice team with more than 5 years service to help reward them for their long-standing support of Stanford Brown. Again, very important, the role our people play. We're essentially in a people business. We've grown our advisor team. We're lucky enough in the last 18 months to have brought on Anita, Michelle, who's come through our professional year program, and Garrick, who's joined the accounting team. And we continue to invest in a professional year. And we've got 3 candidates currently on the professional year or just embarking on it. So we've got Katie, we have Angus Hannon and Angus Cook, both of whom are embarking on their professional year and are very much the future of Stanford Brown. The second core value that I want to talk quickly with you about today is celebrating the wins. A big thing that we've always believed on, and this very much dates back to David and our founder. You're on a journey, you're trying to achieve things for the future, but it's important to stop and pause and celebrate the milestones as you check them off. Sharing a few important wins with you today. We were fortunate enough in August to be awarded 2nd place in the Great Places to Work survey for companies under 100 employees in Australia. That's down 1 place from 12 months ago, unfortunately. We only placed 2nd. Previously, we'd come 1st. It's not the be-all and the end-all for me, but it is important to keep an eye on these things because it is, again, about building a sustainable business. We also celebrate success internally. Now, I can highlight there's no reason for me to be in this picture except ultra vanity. When you exclude me out of the picture, we have our key award winners internally. We have Nikki Bustred, our reigning advisor of the year. Where are you, Nikki? She's always very shy. Yep, always shy, Nikki. We have Robert Batchelor, who's our rising star, and Talia Lucifero, who will be known to many of you, who was awarded our best and fairest. And that is an award voted on by their staff members for the other staff member that they feel most embodies our culture and our values. And unfortunately, Talia would be here, but she's popped an ACL and she's seeing her specialist today. So let's hear it for their award winners. We also have a couple of dedicated awards that we use to celebrate innovation within the business. The first one is the Innovation of the Year, and this year it was actually jointly held based on an internal vote between the team that worked on our new CRM rollout, Fin365, and our team within our Benefits Advisory division that rolled out a Wellbeing Week initiative across a number of our corporate clients. And then our Innovators of the Year, as again voted on by the staff members, by their peers. The joint winners of that were Kirsten and Emma Terry, 2 names known to many of you. Well done, Kirsten. Well done, Emma. And of course, when we're celebrating successes, we cannot pass on the Barron's list, one of now the most respected recognitions of the top 100 advisors in the country. And we only made 2 entries onto that list. We only applied for 2 advisors. They are 2 of advisors with their largest and most extensive books. And goes without saying, are obviously our 2 best-looking advisors. So let's congratulate, sorry, Nikki. Let's congratulate both Todd and Hamish on their role on that list. The third core value I'd like to briefly highlight with you all is the importance that we've always felt around giving back. If you ever stand in our reception, you will know that we have a notice board there that talks about some of our core values, and one of those is that any organization that gains its success from the support of the community has an obligation to invest back and give back to that community which supports us. So let's talk about a few of the things that we do on that front. We are fortunate enough to be able to be a headline sponsor of the Lifeline Harbour to Hawkesbury Gala Ball. There's our beautiful staff members looking their absolute best. There's myself cracking some terribly cheesy joke with Jess Rowe at addressing that dinner, and that's a wonderful opportunity for our firm to support an incredibly worthy cause. And it's worth highlighting, we do have a philanthropy committee within our business, and that philanthropy committee dictates to us what causes in particular we want to support. And the causes that they have called out to our business as priorities are 1, mental health, and 2nd, around poverty in the community. So Lifeline very much helping on both those fronts. A second cause that is a recent one, but one that we very much enjoy, and an initiative of Todd Stanford within our business, is to support the Parramatta Mission, where you get the chance to go out there, help them. What they essentially do is they feed their local community on a daily basis. They may be feeding homeless people. They may just be feeding individuals that due to life circumstances, are finding it difficult to feed their own family, feed themselves. Therefore, they come in, no questions asked around who you are or why you might qualify for a meal. You come through the door, all are welcome, all are fed. So we were fortunate enough to have the opportunity to step out there, help prepare the day's meal. You can see Todd working the barbecue hard there. We serve the meal, and we actually have a chance to sit with those people and eat the meal with them as well and hear their stories. And it's quite remarkable. I think one lady I sat with had spent 6 months living in her car. She was 70 years old. Her brother was in a support housing facility, but she couldn't stay with him because that would have been in breach of his terms. So she'd spent 6 months living in her car before Parramatta Mission had helped her secure some accommodation as well. So it's a very, very worthy cause. And thirdly, I'd like to highlight Kookaburra Kids, another cause probably slightly less well known, but Kookaburra Kids work with young people affected by family mental illness, and they seek to empower them to lifelong knowledge and ability to reach their potential. Again, another incredible cause that we have been supporting for about a year now, and you'll actually find a little card like this on your table. And if you feel appropriate, no onus or no obligation, but we encourage you to make a small donation, if you can, to our fundraising towards Kookaburra Kids. Again, a wonderful cause. So I guess it's a quick run through 3 of our core values at Stanford Brown, but there are many more. But it's all about the future. It's about investing the right way for the future. It's about celebrating those wins along the way, and it's important about giving back to our community on that journey. Most importantly, the people that we should thank are you, those of you in the room that are professional partners or our clients, because ultimately it's your trust in us that allows us to continue to operate and be, and we never, ever take that trust or confidence you place in us for granted. So thank you. Now, those of you that have attended our Insight lunches a few times over the year will know we always like to have a little bit of a competition in the room. We like a quiz element to it. You will find on your table a large envelope. It's a sealed envelope, and it's sealed for a reason. We have a cryptic quiz in there, I think, with about 10 or 12 questions that we'll ask you to fill out. We'll ask you not to unseal that envelope until after I'm finished speaking with Ian McFarlane, please. But then at that chance, you'll have the chance to rip that envelope open, complete the answer to the questions, put your phones away, and then at the end, we will collect those answers. We'll give you a 5-minute warning before we do so. And the winning table will have a bottle of wine carefully selected by our wine expert, Hamish Harvey, there. So a bit of healthy competition, hopefully no disputes at the tables. Thank you all very much again for joining us today, and I'll be back in a few minutes with Ian. Thank you.
Ian McFarlane is a distinguished Australian economist, central banker, and author of 2 books. After an early career as an economist in Melbourne and Sydney, Ian travelled to Europe to work at the Institute of Economics and Statistics at the University of Oxford. Following this, he then moved to the OECD in Paris, returning to Australia and joining the Reserve Bank of Australia in 1979. Ian was Deputy Governor of the Reserve Bank and then was appointed RBA Governor from 1996 to 2006. Ian has been widely recognised for his achievements as a central banker, particularly his stewardship of the Reserve Bank through the Asian financial crisis in 1997. After retiring from the Reserve Bank, Ian was appointed Director of Woolworths, Leighton Holdings and ANZ Bank. And beyond that, he also was made a Companion of the Order of Australia for services to the stabilisation of the Australian financial system. Ian has also gone on to author 2 books, The Search for Stability and 10 Remarkable Australians. And I actually have several copies of 10 Remarkable Australians here, which will go to the people who asked the 2 or 3 best questions of the Ian. So I'll hand over to Ian and Vincent. Thank you very much.
Thank you, Hamish. Thank you. And thank you, Ian. We appreciate your generosity with your time speaking with us this afternoon. I'd like to start, if I can. There's only one place, and that's obviously the interest rate increases that we've seen in the past 18 months. What's your view in terms of where we are now in the cycle?
Well, the economy's definitely slowed, but I think most people are surprised that it hasn't slowed by more. It seems to, this is common to other countries as well. There's been a tightening of monetary policy. The cash rate, the interest rate the Reserve Bank operates on, has gone up from essentially 0 to 4. in 13 months. That sounds like a big jump. But then 4, there's not a very high level of interest rates, is it? I mean, most of our lives, our economy operated perfectly okay with interest rates higher than 4%. So if you look at the level, it doesn't seem all that restrictive. That's the first comment, which helps explain why the economy hasn't slowed so much. The other thing, of course, is that the monetary policy has a lot of effects, but the main effect, it really is on indebted households, 40% or more of people who have a mortgage. But even there, it's really the people with the big mortgage that really get affected most. And a lot of parts of the economy are hardly affected at all. As many of you will notice, if you try and get a booking at a good restaurant, they're still full. So a lot of the economy is not very much affected. The business sector itself hasn't been hugely affected. The Australian business sector is not highly geared. It's in very good, pretty conservative shape. It gets through okay. The resource sector's doing well. Agriculture's doing well. So the pain is really felt in a specific part of the economy, not across the board.
And the economy probably helped by the increase in population as well.
Well, that's absolutely right. And then the big thing is, after that, is we've had this huge increase in population. 450,000 over the last 12 months, up to June. And it looks like the figure up to September is going to be 500,000. Yeah. That's a lot. I mean, typically 200,000 in a 12-month period would be a more normal figure. So all those things have held the economy up, but I still think there's more slowing to come. There will be more slowing to come.
And on that basis, put your crystal ball on, what's your outlook for interest rates? Maybe I should have saved that question till later.
There's a whole industry out there of people, economists working for financial institutions. That's all they do all day. And they compete with each other to see who can pick the particular month where interest rates are going to do something unusual. I'm not really in that game.
Anymore.
Well, all I can say, it was easier to do it, to make the decision, than to look from as an outsider trying to work out.
Second guess everything. Yeah.
But it all depends on inflation. It all depends on, is inflation coming down fast enough? At the moment, it's not really. It's come off its peak. There's a lot of ways you can measure inflation, but nearly every way you do it, for Australia, you come up with a figure with a 5 in front of it. So it's still really running at about 5 point something. The Reserve Bank forecast, I wouldn't use the word forecast, I'd use the word assumption, is that it'll be below 3 by the second half of 2025.
Right.
That's a reasonable thing to say, but who knows whether it'll happen or not. The truth is, no one can forecast 2 years ahead. We all pretend we can, but we can't.
And I guess the market has been pricing in for some time now that when there are going to be cuts as well. So we're probably increasingly moving on from the fixation on how much further we go up and start to fixate on not just peak inflation, but also declining. The market's still pricing in that there's potentially cuts, maybe even as soon as the end of second half of next year, calendar year, I should say.
Yeah.
What's your take on that?
Well, the market's been doing that all the way along, ever since interest rates started going up. If you look at this thing called the short-term yield curve, you can see the market keeps thinking that within the year, they'll be coming down again. And they've been wrong every time. And they'll be wrong again this time too, I think. I think it's highly unlikely that they could be coming down within the year, because they've already established it. It's not as though they're at a high level.
Well, isn't that a debated point, the sort of what should be the long-term neutral interest rate now?
No, I'm not going to go down that path. All I can say is the only way that could happen, interest rates fall within a year, would be if there was a sharp fall in inflation to below 3% by the end of next year, or if there was a deep recession with a big rise in unemployment. And I'm not forecasting either of those things. I think what we're in for is a period of sluggish growth, inflation sort of edging down but very slowly, wouldn't hold my breath. And the outlook for interest rates is either flat or rising.
And do you feel that they have inflation somewhat under control at this stage, or to be confirmed?
Well, it's come down off its peak. But to what extent that was due to monetary policy, or to what extent it was just due to the turnaround of these transitory elements, it's not clear. I think people overestimate how powerful monetary policy is. It's nowhere near as powerful as people think it is. But the other interesting thing that's happened, I think, is what's related to this is the bond market. Really, if you look over the last 2 or 3 years, where's the action been? It really hasn't been in the equity markets. That's sort of gone sideways. The real action has been in the bond market, where around the world, 10-year bonds have gone from 0 point something to, in the US, they touched 5 a couple of days ago. In Australia, they're up to 4 3/4.
So for the first time since the GFC, essentially.
Yeah, that's big news. What that tells you is the optimists who foresaw a quick fall in interest rates have been routed, and the realists who talk about higher for longer, I think, have prevailed. By the end of this year, there will be 3 calendar years in a row where holders of bonds have had a negative return. That's the first time we've ever had 3 years in a row of negative returns on bonds.
But as you said, I think when you spoke on our podcast before, we've come through a period not just of such rapid increases, but from such there's never been such a low.
The whole story is that you started at zero. Once you start at zero, buying a bond is a very high risk proposition that is almost bound to end in tears, and it has.
If you talk investment returns, if we can,
Well,
we've talked bonds, but what about other assets?
No, I'm not really qualified to talk about that, and I'm possibly illegal, in fact.
Chatham House rules.
No. Well, as you know, I've always been, the one thing, since I've been with Stanford Brown, I probably bored everyone to tears by saying stay away from bonds. But I haven't had, and I've been moderately disposed towards equities. Property, I haven't been a fan of property. But I'm not a professional.
It's potentially a controversial view, that one.
Yeah, I'm not, well, at the moment, I'm not saying the long run it's been about, but we're talking about now. But no, I don't think I can really go any further down that path.
We have a very significant transition recently at the RBA. Should we expect anything different from Michelle Bullock than from her predecessor, Phil Lowe?
I don't think the personality will make a big difference. I know them both well, because they both worked for me for a long time. I don't think that will make a big difference. What could make a big difference is if the proposals from the review of the Reserve Bank were to go ahead, which I sincerely hope they don't. But if they did, it would mean that Michelle Bullock would have a much harder job than any of her predecessors and any of her peer central bank governors around the world.
Now, obviously, this is a subject very close to your heart, but for the benefit of those in the room that are possibly less knowledgeable, do you want to talk us through the most substantive element of the change?
Well, the one
or proposed change, I should say.
There's really one substantive element in that the Reserve Bank current board, which is a 9-member board with a majority of non-executive members, is essentially the same as a corporate board or an advisory board. And the proposal is to turn it into a pure decision-making board. And I think that would be a disaster because of the fact that it has a majority of non-execs who are part-timers. And all along their job has been to advise, challenge, see whether the internal advice that that the Reserve Bank's giving passes the pub test. But they never came to the meeting thinking, oh, I'm going to make monetary policy. But if the proposal were to go ahead, at each meeting there would have to be a vote, the vote would have to be recorded, and the vote would have to be published. So it would turn them into a pure decision-making board.
Let's delve a little bit deeper into that one. But first a question, the political narrative around this one has been the adoption of international best practice. From your experience, how would you place what's proposed versus, say, international peers such as the US Fed or the Bank of England?
Well, it's not international best practice. In fact, it's the opposite of international best practice. There's only really about 9 central banks in the world that we could compare ourselves to. I mean, proper central banks that are independent, they've got their own currency, it's a floating currency, and they've got open capital markets. And 5 of those, the board is composed entirely of internal members, professional central bankers. That's the US, the European Central Bank, the Bank of Japan, Bank of Switzerland, Bank of Sweden. And there's 4 where they have a mixture of part-timers and full-timers, which is the Bank of England, Bank of Canada, Bank of Norway, Reserve Bank of New Zealand. But in each of those cases, the part-timers are a minority. So what this review has managed to come up with is a situation where the part-timers are a majority. And no one has ever attempted to do that. And so that's why I refer to these proposals as an experiment. An experiment we don't know how it will work out because no one else has tried it before.
The other prevailing narrative was that these are only modest changes. Do you feel that there's been a deliberate misleading of the public in terms of what's happening?
No, I don't think so. I think they just simply didn't think it through properly. I think they thought they were being moderate because they didn't change the numerical structure of the existing Reserve Bank board. But that's the problem. I mean, if they're going to make it a decision-making board, they should have changed the structure. So they ended up, they've fallen between the 2 stools. And I think it was just an accident. I just don't think they had the knowledge.
The background, the competence to make these calls?
They didn't have the depth of knowledge to this review panel to come to the right conclusion. I think it's just an accident.
And who is envisaged to play these now potentially very important roles as the part-timers on that, the 6 part-timers on the board?
Well, we know who the current board are, but we don't know who these people would be if the proposal was to go ahead. By the way, I don't think it will. I think it's actually withering on the vine, partly because of my outspokenness on the subject. But if you read the review, you would think all the part-timers, excuse me, would be professors of economics.
Is that a board you could have worked with, some professors of economics?
Well, that wouldn't add much because the Reserve Bank's full of PhD economists anyhow, so you wouldn't have, it'd just be more of the same.
Yeah.
But there's also provision for other people to be appointed. And the decision, of course, always has been and will be with the Treasurer. But we've had one indication of the Treasurer's thinking because the same day that he put out the review, 2 of the board members' positions became vacant because they had reached the end of their contract.
Right, so there was 2
so he had
spots
opportunity to appoint 2 board members, and he chose 2 people with a trade union background. very different to professors of economics. So all it means is we have no idea. We have no idea. The Treasurer has got complete discretion, as they always have, to appoint whoever they want. So in other words, you've entrusted 2/3 of the decision-making power on monetary policy to a group of 6 people we know nothing about. End of story.
And you indicate that this is, you're growing in confidence that this may not. What would be the next steps if this was to come to pass? What would, in terms of legislation, or
There's some legislation that's supposed to be being drawn up, and I don't know.
A period of consultation.
You won't know until the middle of next year.
Yeah.
But I notice in a recent speech, not speech, an article he wrote, the Treasurer, instead of talking about renovating the Reserve Bank, has now said that his idea would be to refresh the Reserve Bank.
Right.
And I think refresh is a lot smaller than renovate.
We're almost now back at modest tapering and moderate tapering. Now we've got renovations and refreshes. So, okay, that gives you cause for hope. Thank you very much. We do have time for a couple of questions. If anyone in the room would like to put their hand up, if we got some, we have a roving mic coming down the front here, if we can, please, and we'll jump over there.
We've got over here.
We've got up the back because there's a mic there.
Hi. The price of oil and the effect it's having on consumer inflation, is that, it's probably one of the most visible things that we see is the price of petrol at the pump. What's the ultimate flow and effect of the price of oil as it is? And say, if by a miracle crude prices dropped tomorrow, how much effect would that have on the inflation levels?
Well, it'll have an effect on the inflation level, but when you're making your assessment of the underlying rate of inflation, you look at each individual item, you take certain volatile items out, and so you look at what's left, which is mainly services, and that's your measure of core inflation. And so you're really making a judgment more on what you think core inflation's doing, and you don't let yourself be unduly influenced by a big movement in any one particular item.
Grab a question over here.
Thanks, Vincent. Howard Smith. Ian, fantastic to listen to your anecdotes, I have to say. Can I ask for an opinion or a view from, I guess, your time dating back to maybe the mid-90s, where I'm expecting you probably had quite a degree of exposure to Paul Keating as Treasurer. Obviously, your appointment under Peter Costello when he was relatively new and relatively young as well too, and grew into the role. And I guess from the sideline watching our new Treasurer, Jim Chalmers, just curious if you'd like to offer any observations, insights. Vincent, recognising your view on Chatham House rules as well.
Yes, well, Chatham House rules only get you so far as well. Yeah,
well, I was appointed Deputy Governor by the Keating government and then Governor by the Howard government. So I've worked both sides. Very amicably. My main association with treasurers were with the two best treasurers we've had, which are Paul Keating and Peter Costello. I think that standard has not been able to be maintained. On the current treasurer, I don't really want to say much other than the thing I've been talking about, this reform of the Reserve Bank or review of the Reserve Bank. I don't think he has very strong views at all. I don't think it's not as though he's on a crusade. I think he simply wants to be seen, like his idol, Paul Keating, as a reforming treasurer who gets things done. And I don't think there's any evidence that he has strong economic views on the subject at all.
So
it's a political event. It's a political event. It's not an economic event.
And perhaps he originally thought that this was only to be a modest.
Oh, well, I think he did. I think it was assured. I'm sure that his department assured him that it was very moderate.
Question at the front. Last question. Thank you.
My question relates to the first question, the Middle East situation at the moment, and the impact it has on markets.
Well, I don't think it really has an impact on monetary policy. I think it's more likely to have an impact on what Stanford Brown has to think about, the returns for investments, and particularly in equities in particular sectors. But for monetary policy, as I tried to answer the first question, if there's a temporary rise in oil prices, you look through that. You don't say, oh, I've got to change monetary policy because oil prices have gone up.
I think we'll have Nick Ryder, our Chief Investment Officer, back up here in about 15 minutes, so he will be certainly there on notice to talk events unfolding in the Middle East. But Ian, thank you very much once again. Excellent as always, and good luck on your crusade.
Thank you.
Okay, firstly, thank you to Ian for your time and insight, and for Howard trying to get more information out of him. Appreciate that. Now, a few of you here in the room have heard from Nick Ryder before, and you may have heard him on our podcasts that we put out pretty frequently. And I actually encourage you all to have a listen to those podcasts if you haven't already, because they're meant to be fast, short snippets of information about our outlook. But I might just introduce Nick because it's obviously relevant now and relevant to the sorts of assets we'll be talking about. So Nick is the Chief Investment Officer at Stanford Brown and has been with the firm since February the 1st this year, 2023. Prior to his current role, Nick worked at various firms where he had a strong focus on alternative investments. And this ultimately culminated in Nick establishing a fund of hedge funds in 1999, which he ran for several years. Nick then moved to Citi in 2001, where he became the head of alternative investments, overseeing a range of alternative products for institutional and high net worth investors, a topic we will specifically discuss today. Nick spent the decade after the GFC at NAB and JB Were, where he played a role in the construction of client portfolios for wealthy individuals, families and not-for-profit clients. Nick's most recent role was at the Commonwealth Bank Private, where he was the senior investment strategist providing macroeconomic and strategic asset allocation advice, which is something we'll be talking about now. Nick is a well-versed investment professional with broad industry experience, and he has 30 plus years in investment management. So I'll hand over to Nick and Vincent. Thank you.
Thank you. Thank you very much, Hamish. Welcome to a live version of the SB Talks podcast. Today is Thursday, October 26th, and I'm joined once again by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Force of habit, I'm sorry. I'd actually like to start, if we can, Nick, by we're past the 6-month mark of you formally taking the reins of Chief Investment Officer, and maybe cast your mind back for the benefit of those in the room in terms of some of the priorities you had upon taking the role.
Yeah, I think what I was excited about when I joined Stanford Brown was really bringing a lot of the background that Hamish just went through all together into one role. So alternative investments, manager research, high-level asset allocation and investment strategy, and also, taking on the role of Chief Investment Officer, which is still pretty hands-on. So previous organisations I worked, the CIO was really just a people manager and was largely disconnected from what was going on in markets, and often even didn't spend a lot of time with clients. So I think that's what excited me about the role it is.
Definitely a hands-on role. Let's start with the basics. You've recently undertaken a review of the strategic asset allocation. Just explain at a high level, what is asset allocation and the role that you seek for it to play in the portfolios?
Yeah, so asset allocation is really the blending of different asset classes. And when we talk about asset classes, we think about things like equities, bonds, cash, property, etc. And trying to blend those in a way that provides a better risk-adjusted return for clients. And so, it's what I've spoken about probably on podcasts and things. It's the only free lunch in financial markets that blending different asset classes that aren't correlated with each other provides a better risk-adjusted return. And what do I mean by correlation? Correlation is that it's actually a mathematical measure of how two assets move together. So if assets are perfectly correlated, they have a correlation of 1. If one moves up 10%, the other moves up 10% as well, that would be a perfect correlation. And perfectly negatively correlated would mean they do the same thing, but in opposite directions. And so what we're trying to do with asset allocation is find asset classes that aren't perfectly correlated and blend them together to build better portfolios, because we don't have a crystal ball.
Neither you nor Ian are offering your crystal ball up today.
That's right.
So essentially we're obviously trying to achieve an end result in terms of a return, but also trying to smooth the journey along the way.
Yeah.
And let's talk about the role that strategic asset allocation particularly has in portfolios. And perhaps also the process that you've gone through to review that for our clients.
Yeah, so the portfolios that I've taken control of hadn't really had that strategic asset allocation looked at since 2016. And I think these things are always worth reviewing in light of your views about the environment we're heading into. So I've got a chart up there that just shows the returns of different asset classes in the calendar year of 2022 and also in the last 3 months. And what you notice is a lot of things went down. You know, inflation is not good for asset classes because it generally means higher interest rates, and a lot of things get repriced when the risk-free rate goes up. So we've seen that with bonds, we've seen that with equities, we've seen that with property. And so I thought, if we're going into an environment where things like there's de-globalisation, decarbonisation, there's a lot of debt, there's a lot of spending on defence now because of geopolitical risk, that could potentially be a more inflationary environment. And I wanted to have portfolios that were more robust in that scenario.
So what's the process that you went through?
So I've got a chart up there that actually just explains, you know, how the correlation between bonds and equities behaves under different inflation regimes. And you can see when inflation's above 2.5%, bonds and equities actually move together, and that's not good for the traditional 60-40 equity bond portfolio. So what do we need to do is we need to include other asset classes that hopefully zig when those asset classes zag. And so we did a big amount of work. We worked with Jana, our investment consultant that you mentioned, and we embedded their capital market forecasts and their assumptions about risks, returns, and correlations of the different asset classes. And we tried to rebuild these portfolios using a combination of science and art. So the science bit is the mathematical optimization process, and the art's then taking, okay, does this make sense for clients? And where did we get to? Well, one of the things that came out of that review was that we probably had too much in Australian assets. We had a home country bias. We had 50% in Australian bonds and Australian shares. Whereas, you know, the Australian market is only about 2% of global markets. And the chart on the left shows, you know, the colour coding of the different asset classes, how they correlate. And Australian bonds and global bonds are very correlated with each other, surprise, surprise. And Australian shares and global shares are very correlated with each other. So we decided to dial both of those asset classes down and to use that money to fund an increased allocation to alternative investments, something that I had experience with going back a long time.
Historically, and alternative, that's somewhat...
For bonds and equities.
Well, let's talk bonds very quickly, because I know it's a passionate subject close to your heart. We've seen, as Ian touched on before, the rapid run-up in US 10-year Treasury notes to above 5% for the first time in 16 years. Obviously that, with those types of, if you hold those bonds while rates are on the rapid increase, you lose capital.
That's right.
And one of the key questions in the room for many people here will be, well, why invest in bonds given the negative capital experience of the last few years? What gives you confidence that now is the time to step back into that market?
Yeah, so when bond yields were, you know, 1.5% not that long ago, and the cash rate was 0, there was really only one way for bonds to go. The risks were asymmetric. You were only ever going to lose money in bonds. Now, with bond yields back at 5%, which you can see from the chart is almost double the Fed's estimate of the neutral rate. Now, we can debate whether 2.5% is the right number for the neutral rate, but
so for the benefit of the room, the neutral rate is sort of that long-term interest rate that should be neither accelerating or decelerating the economy. It should be their default position.
Well, exactly. They've increased interest rates to close to 5.5%, and they think that's restrictive. So they're saying interest rates are above the neutral rate. Now, they think it's 2.5, but it could be higher. We won't know. But it's certainly restrictive. And so the 10-year bond at close to 5% for the next, so basically saying interest rates are going to be around 5% for the next 10 years. Yeah. Very restrictive levels, potentially. So I think that makes bonds far more attractive proposition. Yeah. And if inflation moderates over the next couple of years, then there could be some upside.
Then the reality is that 5% rate is too high. It does come back, and you get the reverse of what we've seen in recent times, which is some capital upside.
That's right. So the risks are more symmetric. Yeah. So we're neutral bonds now. We've added back fixed rate bonds into the portfolio, moved out of floating rate into fixed. We're not saying rush out and buy them with your ears pinned back, but we just think they're now adding a bit more diversification in the portfolio than they have in the past.
Yeah, so we've been very underweight those fixed rate for the last couple of years. Now is an adequate time, reasonable value to step back in and have some exposure there. Yeah.
And that's right. And also, if you're buying corporate bonds, which you do if you particularly globally, you know, an investment grade corporate bond can give you 7%, which is pretty attractive relative to history. And if inflation comes down, it will give you a nice real yield as well.
Yes. We are just coming back in again to corporate earnings season in the US. Do you mind if we start to talk there? And you mentioned before the Magnificent Seven. They were the big driver of a lot of the returns in the early parts of 2023. It's very early in that earnings season, but what have you seen so far, and what in particular are you looking out for?
Yeah, it's still early in the third quarter reporting season in the US. It's been fine. It's, you know, the number of companies beating estimates is around average. You know, we've had, you know, some good wins. So Microsoft had a pretty good result. You know, people loved its, you know, how it's doing in its what they call intelligent cloud business. Google also had a good result, but its cloud business was a bit disappointing, so it sold off. Meta last night had a good result. So the numbers are coming through, you know, being pretty strong. Okay, there's, you know, pockets of disappointment. Tesla, you know, is one of the Magnificent Seven that showed it had to discount its cars. But by and large, you can see from the chart on the right, they've held up very well, even in the latest sell-off. You know, these are companies that are generating a lot of cash, fat profit margins. Most of them have trimmed their staffing earlier in the year. So they've sort of right-sized their cost structure. So it's still a pretty good environment, and they've got that structural tailwind from AI and everything moving to the cloud.
And that gives you confidence, I guess, to maintain, not just in that sector, but equity exposure in the portfolio.
Yeah, so we're neutral in equities overall. We can't see any reason, you know, when we look at the 4 factors for dynamic asset allocation, which is our tilting of the portfolio, so economic environment, valuation, sentiment, these all point to being neutrally positioned. Now, you know, it's possible that equities trade sideways through the rest of the year, and, you know, there's potential speed bumps in the US, for example, with a possible government shutdown, although it looks less likely now they've appointed a speaker. But, you know, United Auto Worker strike and higher gas prices and higher interest rates. So there's a few things that you could get worried about, but by and large, it looks like it should be fine.
And there's always going to be something to be worried about.
Yeah, absolutely.
Well, and we've literally only got time for probably a couple of questions, and I will start with the first question here from the floor, because that was follow on your question before to Ian McFarlane, which is, how do you, unfolding events in the Middle East, obviously a horrific humanitarian situation there, but what impact, if any, does that have in terms of how you think about the risks to portfolios?
No, so we always look at geopolitical risk as one of the risks, and you know, it's certainly, you know, the last 30 years have been relatively quiet on that front, and so it is something that does look like it's becoming a bigger risk, particularly with what we call multipolarity, where you have the world splitting into US and democracies, and you have Russia, China, and Iran potentially forming another autocratic bloc. So I do worry about it.
The NATO bloc and almost the anti-NATO bloc.
That's right. Yeah. But certainly from a market perspective, we've seen very little reaction. There's probably a little bit of what we call a geopolitical risk premium in the oil price at the moment, and certainly gold's done well. Bonds haven't really responded in the way that you might think, and the Swiss franc is another sort of safe haven asset that's done reasonably well. So I think if it doesn't escalate, if Iran doesn't get drawn into the conflict, then it probably has no real implications for how we think about portfolios.
Yeah. If Iran comes in, that's a very different picture. And time for one more question, so I'm just going to come down the front here. If someone can it's just coming from behind you, sorry.
I heard that you mentioned environmental stocks, and I am interested in digging in further there. There's a lot of climate change, as I think we're all probably aware, and that seems to be increasing in terms of various geographical disasters, etc. And I'm wondering what your perspective is on climate change and how you're investing towards making an impact in that area.
Yeah, and I think probably could add to that climate change and the commitments to move to net zero, and I guess there's certain major changes have to occur through that process.
Yeah, I wouldn't say that we explicitly factor it in. So JANA do have in their capital market forecast, they do take it into account. So at a broad sort of macro level, they're climate aware forecasts. A lot of the managers that we do use, the active managers, are very aware of it and do take it into account. But I would say that sort of broad portfolios are not overtly climate aware. We do have energy stocks, like Woodside, for example, in the portfolio.
Yeah. Unless specifically requested not to have it, which makes up a big part of the Australian Stock Exchange, which we've probably reduced our exposure to ASX.
Yes, but also the big energy stocks in the MSCI world as well. So we're still exposed to it. For clients that want to get more green or have more ESG friendly portfolios or more carbon aware portfolios, we can build those. We have all the data now to track at a manager level and also individual stock level, you know, what the carbon footprint or the carbon score is for particular portfolios.
Thank you very much, Nick, for that whirlwind tour update on your 6 months in the job. Congratulations.
Thank you everyone for coming along as well, of course. We'll do some of those things more formally shortly. But joining me on the stage now, I've actually got a new colleague, Joey Maracade. So by way of background, in 2022, Ashley Ong, who was our Chief Investment Officer, decided to step back from that full-time role. It's not a stress-free role being a Chief Investment Officer for portfolios. Stanford Brown looks after well north of $2 billion of your assets and client assets. So it's a very full-time role. So Vincent and I really met a few people, a small group of professional investors, chief investment officers, say, in the marketplace. And finally we made a wonderful decision and got introduced to Nick Ryder and headhunted him out of Commonwealth Bank, and that's who you just heard from now. But along that journey, I was actually introduced to someone totally different, and that's Joey Maracade that sits here with us today. So I'm not going to introduce him because I want to allow him to introduce himself. Joey is not the Chief Investment Officer, but he has taken the role of a newly created role, and that's what you do when you meet someone who's just so good you've just got to pay for them, obviously. So he is a Senior Investment Director at Stanford Brown now. He's got a lot of responsibilities, and so we're going to have a 10-minute Q&A with Joey and find out more. So Joey, you've been with us for just over 6 months now. Could you share us a little bit about yourself and why you're here?
Sure. So I guess, as Jenny mentioned earlier, I've got nearly 20 years now in financial markets. Probably my career can be split into two broad groups, offshore and then onshore in Australia. So I finished my degree, my master's degree in London, and started off at UBS Wealth Management in working for high net worth clients and investment solutions, and flipped over to sort of broad investment bank where the Royal Bank of Scotland. And probably the best way to think about my role there is I was close to the manufacturing end of the products and investment solutions. So we would build off-the-shelf ideas and products for clients that were popular. We'd customise solutions for clients, and we would create ideas and solutions that might be relevant for different market conditions at the time. So that was all brought in pre-global financial crisis all the way through to 2010 or so in the UK, and I did the same sort of thing in Asia, Hong Kong and Singapore. So I spent about 7 years in total doing that sort of work before taking the opportunity to rejoin UBS Wealth Management here in Sydney, where I headed up the investment advice and portfolio advice team at UBS Wealth Management. And I spent a lot of my time there focusing on portfolio construction and asset allocation. So Nick just went through how we run asset allocation here at Stanford Brown. I went through a similar process where I got really into the weeds and creating the asset allocations for UBS Wealth Management clients across the country in Australia. And really it was, we had preset portfolios as you'd expect. And I dealt with clients for from $1 million all the way up to over $1 billion. And at that top end, a lot of customization would be required, given their complex situations and different investment assets they might hold already. So a lot of modelling and using their models there to build that. And then I flipped over to Credit Suisse and ANZ Private for 7 years subsequent to that time at UBS. Before joining Stanford Brown.
So there's some pretty interesting names and you global banks Yeah, so why did you take the opportunity to join a boutique advisory like Stanford Brown?
Yeah, I found that all those firms, and they're great firms with great teams, but a lot of what they do, they have to manage a business for thousands of advisors globally, hundreds of thousands of clients, and so a lot of their approach is very fixed. So a lot of work went into setting up the portfolios, the ability to be customizable and actually do what's right for the client, very specifically tailor things that suits individual clients and package up different things that might work for them from an income basis all the way through to optimizing their risk and return for that particular individual was much more difficult to do. And nowadays, over the last sort of 5 to 7 years, a lot of the highest quality things you might find in a big firm are available to smaller firms like Stanford Brown, but not too small. Stanford Brown's big enough to be able to get access to, for example, the highest quality investment committee, members like Ian McFarlane, former RBA governors, China Consulting, who are the largest advisors to the superannuation industry, advise us, as well as top quality platforms, the global leading investment solutions that come out of the US and Europe, we have access to that as well. So there's been a huge democratization around that space that allows us to deliver that sort of boutique offering for an individual client without sacrificing any of the quality that goes into that process. So I've jumped at the chance to take advantage of that.
Okay, so what we're going to change gear a little bit, and one of the important things that I see our role doing for you, for clients, is researching and analysing some of the investment universe that is out there, and you expect us to have good ideas. And one of those sectors that we think is important is private markets, private equity. And we're going to talk just a few moments about what that means and what that is specifically for you, the types of returns that we think are reasonable to expect. So Nick has already talked a little bit about strategic asset allocation. Vincent and Nick talked about that merger and arbitrage fund that we do have in your portfolios at the moment, which is very interesting. But there's something else, private markets. So let's talk about that. So can you just introduce for everyone in the room what are private markets, please, Joe?
Sure. So probably the best way to think about private markets is the type of investment that's not as easily available to everyday people. So generally, if you buy shares on the stock market, that's public. It's on the exchange, anyone can go in and buy a share and sell a share on it. Private markets probably a little bit more like your property. So most people own a property. If you wanted to understand the price of the property, you haven't got it listed on an exchange anywhere. You have to make comparables to other similar properties, the area, maybe the rental yield might generate, and backsolve the price for that. So private markets could work across a spectrum of areas. With private equity as an example is the comparable to the share market, where it's ownership in private businesses. So rather than taking ownership in listed businesses, you take ownership in private businesses. And similarly, the price of those businesses aren't that clear to everyone, so you have to do a lot more work to understand where the real value is in that. You can add value through that process as well by owning some of those private businesses.
So let's talk about adding value. Let's use an Australian example of one of the investments that we use.
Sure. So, I guess probably the most straightforward process of adding value is buying a company, a private business, through a fund, because some of these things can be very expensive to buy. Obviously, you go through a fund where they buy multiple businesses. Understanding the value of them, buying them for a cheaper price, and then adding value. The most simple way to do that is reducing the cost of the businesses. So optimizing that business that might be inefficient, reducing the cost without hurting the revenue, finding ways to grow that revenue, and then naturally growing the profit, and selling a business for cheap, more expensive, whilst also having grown the profits, which will also increase the price. So an example of something similar to that would be Partners Group, which is a fund that we use to get access to a lot of private equity investments. They bought a childcare centre called Guardian Early Learning back in 2016. They paid about $440 million for it at the time. Guardian was the largest corporate-sponsored childcare service in Australia at the time. So that was their first foray into the childcare space in Australia. But Partners Group, being a big global private equity firm, actually had 15 different childcare investments across the world, one of which was KinderCare, which they bought in the US the year before, in 2015. And there was the largest for-profit childcare centre in the US. So they'd already owned that, they owned 14 others, now they bought an Australian business, and they used that expertise, understanding all those businesses and the scale they could use from that, to put 2 members of their team onto the board of Guardian here in Australia to help support the existing management team to optimise and grow that business. At the time they bought it, it had 71 childcare centres across the country. They had plans for another 10 at the time to 81. At the moment, they are looking to sell that business They bought it for $440 million 7 years ago. They're now looking to sell it for over $1 billion, more than double your money in 7 years, and they're around 110 childcare centres, up from 71, 81 at the time. So that's the kind of thing they can grow the business, optimise the value, and well, double their money, more than double their money in 7 years.
So, and it has less volatility. It's a smoother ride as well when you think about it, because it's just a private enterprise just growing its value year after year, as opposed to depending on what the stock market does, which is very emotional. We all know just rising and falling, and irrespective of how the business is performing. But 7 years is a long time, an investment cycle. So our clients expected to lock up their money for 7 years. Let's just talk about liquidity.
Yeah, certainly traditional private equity funds, they raise money, go out and buy a bunch of businesses, invest them over a period of time, and return that money over 5, 6, 7, up to 10 years. Partners Group are actually one of the pioneers to enable a way to invest in that way without necessarily having to lock your money up. You have to be a big enough fund to be able to do that, because they're buying have so many businesses over the last 15, 20 years. They're always selling more businesses, which means the money's always coming out of the fund, and they're able to use that cash flow to return money to investors. Well, money's always coming in, money can always come back as well through that process, selling businesses, but also to enhance the liquidity further, they hold small amounts of cash and small amounts of other asset classes or other investments, called private credit, for example, which are a little bit more liquid than private equity. So rather than businesses, they have different types of investments that have much shorter maturities. Using those things, they can return the capital. It's very complex, the way they manage that cash management. Not everyone can do it, but people are trying. Partners Group, as I mentioned, are one of the first to do it. Have done it very well for a long time. They do stress at the end of the day, you are invested in illiquid investments. So there's not a guarantee that they can provide that liquidity on a monthly or quarterly basis. But to be fair to them, they didn't lock up in the GFC or in COVID, so far so good.
Expected rate of returns on I mean, there's a range of, there's this semi-liquid, we call it, private equity, which might be able to trade, might take you 90 days or 120 days to get access to capital, versus some of these which have 10-year lock-up. So there is a range of different PE that we look at, private equity.
Yeah, I mean, so traditional public equity, the shares that you buy, if you just buy the market over time, everyone will have a slightly different number, but generally you can expect around 7 to 8% a year over time, right? When you start to go into the private area, because you're able to buy those companies a little bit cheaper in terms of price discovery, isn't as transparent, because you're able to add value to those businesses, and because you have to be compensated for the fact that you might lock up some of your money for a period of time, all that adds return to your to the public market equivalent. So 7 to 8%. In private equity, you can probably get towards 10 to the real those bigger funds that lock up for much longer periods of time, toward that 15% mark. But yeah, 10 to 12% is usually in private equity what you might expect as a benefit over public markets. Yeah, over time.
So there's one, I know we're running a bit over time, but I think it's valid and you'll be interested. So another asset class that we hear about frequently, and Nick's telephone rings probably once a day, and mine and Joe's and his, is private credit. So all of these different funds that are sort of popping up around the country at the moment. Let's just talk a little bit, what is private credit in an Australian context, and some of the returns and what they are.
Yeah, so as I mentioned, Private Partners Group and the like have slivers in private credit. They're also standalone private credit funds that you alluded to. So private credit, in the simplest form, in the majority of cases, are effectively loans to businesses, in the main, or investors that cannot get those loans out of a bank. Why wouldn't they get their loans out of a bank? Now, banks are getting increasingly regulated, and they have effectively a checklist. You don't need that checklist, they won't give you the money. Those checklists apply to many people, but they don't apply to all good borrowers. There are plenty of very excellent borrowers that can borrow money, that have great investments that they want to use that money to deploy in great businesses, great cash flow. Doesn't necessarily meet the tick box of the bank, and so that's where private credit funds come in. They'll raise money from investors, lend their money out to these good borrowers, and are able to lend it out at a higher rate than the bank would, which is effectively the rate back to the investors. So we're talking in that sort of 8 to 10% range return. So the private credit funds hire the same credit analysts from banks to work in their private credit fund to do the same work a bank would do in terms of the creditworthiness of these loans. So that's one example. Banks also love the residential property market. They make loads of money out of lending money to everyday salaried employees against very good properties out there, and so they focus there. Whereas maybe a self-employed investor, a self-employed person, business owner might find it more difficult to get money out of the bank. Again, private credit can step in and help lend against other types of residential developments or properties. We tend to stay away a little bit from that. There's a lot of money that's gone into there. It's the sort of things Australians like, and it's the sort of thing that has a lot of risk in it, given the growth of that space. We tend to focus more on the direct lending to business owners and some private credit space.
And this is increasing. This is an important asset class, and it is really complex. And you can imagine we do spend a lot of time. So Jana and Nick, the whole investment team, and we often and frequently conduct full interviews where we've got the fund managers coming in pitching to us for your money, and we're literally filtering them out. You can imagine there's quite a few of them that we've got a criteria, they just don't even make the first cut, and that's our job, to bring the ones that pass the cut and we think are appropriate for your portfolios.